So negative gearing rules have changed and property prices in many parts of Australia are starting to soften, leaving many investors asking one big question. What does this mean for your average Australian, and is property still a worthwhile investment? In this video, I'm going to walk you through what has changed in plain English, and then we're going to look at some real numbers. Hi there, my name is Phil McGilvray. I'm a former financial advisor and now financial coach, and I've spent 30 years helping my clients understand how negative gearing actually works. And then on the 12th of May, everything changed. So I've had plenty of clients asking me, Phil, what do these changes actually mean? How will it affect me? And does this mean that investing in property is no longer worthwhile? So in this video, I'm going to cut through all the noise and make this as simple as possible for you. Firstly, we're going to look at, well, what actually are the changes that have occurred? Then we're going to walk through some real numbers together. So I'm going to bring up my spreadsheet, the spreadsheet that I use with all of my clients, and walk you through some real life numbers so you understand what it means from a cash flow perspective. And then we're going to have a look at the very big question, does investing in property still make sense? So just a quick reminder, I am not a financial advisor. This is definitely not financial advice. This is for educational purposes only. Anytime you invest, there's always going to be risk attached to that investment. So please make sure you do your own homework and speak to your professionals, maybe an accountant or financial advisor, before you start investing. So let's have a look at what negative gearing actually is. Negative gearing is where you buy a property that costs you more to hold than it earns you in rent. So if we look at a simple example of this, let's just say we've got a property that's paying us $22,500 in income, in rent. Our interest on our mortgage is $24,000. We're paying $2,500 in rates. We're paying $1,800 in land tax. We're paying $1,900 in landlords and building insurance. We're paying $1,350 in management fees, and maintenance is $2,000 a year. So you can see the total cost of holding that property is $33,550. So if our rent is $22,500 and our costs associated with the property are $33,500, you can see we're making an $11,000 loss on that property, a cash flow loss on that property each year. This is what's happening when we're negative gearing a property. We've got a negative cash flow. Now, up till now, under previous tax laws, we've then been able to take this $11,000 and reduce our taxable income. So if I've got a salary of $110,000, then I can take this $11,000 and it will reduce my taxable income down to $99,000. Okay, so let me take you through the spreadsheet that I use with all of my clients to help them understand how does negative gearing actually work? What do the numbers look like in my situation? Now, if you'd like a copy of this spreadsheet, you can grab a copy if it's free. There's a link in the description below. So let's go through this. In this first column here, I always provide the scenario of I don't have a property, I just have a salary. So we can compare what it looks like when we do have a property. So let's just say I have a salary of $120,000. I've got no rent coming in. I've got no property costs. So I've got my $120,000 that I get taxed on. I pay tax of about $28,920. The tax saving is zero for me in that scenario, and my take home is about $91,080, and that is about $3,500 a fortnight. So that's what it looks like without a property. Now, under negative gearing rules, let's say I buy an investment property. That investment property is giving me the $22,500 in rent we were talking about a minute ago. That means my income, my total income is $142,500. So we add together our salary plus the rent. But then, of course, we have all the costs associated with owning the property. So we've got the interest on the loans, we've got the rates, we've got the body corporate, we've got the land tax, we've got the maintenance, we've got the insurance, the property agent's fees. I've left depreciation out of this one because I don't want to confuse things. But then we've got the total expenses. The total of all of those is $33,500. So as we identified a minute ago, we're earning rent of $22,500. We're paying $33,500 in expenses. So we're basically making a cash flow loss of $11,000 on that property. Now, under the negative gearing rules, I could use that $11,000 loss to offset my taxable income. So you can see here, my taxable income without a property was $120,000, but with a property, it's now $108,950. So that means that I only end up paying $25,384 in tax on because I've got a property, because all of those expenses associated with the property, that loss, that $11,000 loss, reduces my taxable income, which means that I end up paying less tax, and I save myself $3,536. Now, it's worth noting at this point that, yes, I saved myself $3,576, but remember, the cash flow loss was $11,050 to start with. I've got $3,536 back. Great, but my cash flow loss is still $7,514 a year. So it is really important that you always understand the numbers when you're buying a property, regardless of the tax rules. What does it mean for me from a cash flow perspective? And can I afford a $7,514 cash flow loss every single year? Okay, so that is how negative gearing works. Okay, so let's have a look at what's changed with the May 12th budget. I'm going to take you through these fairly quickly, and then we're going to come back to each one of them in a little bit more detail later on. But first thing to note is that negative gearing will not apply to any existing investment properties purchased after the 12th of May 2026. And by existing, what they're talking about here is an existing property that's already built as opposed to a new build. However, for new builds, negative gearing rules will still apply. So if you're buying a brand new property as an investment after the 12th of May 2026, you can still apply all the negative gearing rules to your situation. Very important to note too that any investment properties that were purchased before the 12th of May 2026, you have been grandfathered. You can still benefit from all the negative gearing rules and all the capital gains tax rules that were there before the 12th of May. And the new tax rules will take effect as of the 1st of July 2027. So we've got to take a year to let it all sink in. We've got a year until these will take effect. So the key date, 1st of July 2027. Okay, so let's have a look at the spreadsheet again. We've already seen the impact that negative gearing has on reducing your taxable income, but let's now have a look at what it looks like to own a property, the same property, without the benefits of negative gearing. So we've got the same income, $120,000, same rent, $22,500. We've got the total income of $142,500. All the same expenses associated with owning the property, so they total $33,550. But this is where the changes come, because without negative gearing, you cannot offset property losses against your salary, which means that you can only offset enough to cover your rent. So in this case, the rent's $22,500, so you can only deduct $22,500 of your $33,000 in losses, which means that your salary remains untouched. It doesn't benefit in any way from owning this property. You pay exactly the same amount of income tax and Medicare as you would without the property. There are no tax benefits from a cash flow perspective, which means that the $11,000 difference between the actual cost of owning and the amount you can deduct to $22,500, that $11,000 becomes your loss. Okay, it becomes your cash flow loss. So you need to be able to wear that every single year and hope that your property is going to increase in value more than the loss you're making in cash flow. So I'm really hoping that those numbers have made sense. Clearly, without negative gearing, it becomes a lot harder to hold on to a cash flow negative property. But does that mean investing in property is no longer worthwhile? Well, let's go through a few points here. Firstly, it's always really important, this is what I take all of my clients through, is know your numbers. Can you afford to hold on to this property? Do you understand what impact an $11,000 loss per year, as in our example, would have on your cash flow? Because no house, no investment is worth an oppressive mortgage, an oppressive financial situation. So it's really important that you sit down with a spreadsheet similar to the one I use, You can download that if you like, similar to the one I use to help you understand what are the numbers going to look like for me. The second thing is you obviously need to put more emphasis on capital growth. We want to make sure that if we're losing $11,000 a year in cash flow, that we're seeing strong capital growth in the value of the property. So investing wisely to start with, buying a good property in a good area with good transport links and good schools and good job prospects has become even more important than it used to be. The third thing to note here is that new properties are unaffected. So if you're thinking about investing, maybe you do need to focus on new properties because you still get all the same benefits of a negative gearing. So none of that has changed for new properties. And the fourth thing you need to consider is the impact that these changes will have on the housing market. And I don't think anyone knows what's going to happen at the moment. You've got the media telling you that the housing market's crashing because Melbourne's dropped 2% and Sydney's dropped 1.5%. That's not a crash. But the reality is no one quite knows what's coming next. So personally, I would be waiting for things to settle just to figure out, well, what is the housing market going to look like in 6 months, 12 months, 18 months time? Will it get through the initial shock and then just move on as it has done every other time for the last 30 years? Or is this going to be a more sustained downtrend? So these are the things you just need to consider. And the fifth thing to consider, and this is potentially a very positive thing that came about with these new tax changes, is that any losses you're making, so the $11,000 per year losses we were looking at just a moment ago, those can be accumulated and then offset against your future capital gain. Now, I've created a whole nother video where I take you through the capital gains tax changes that were announced on May the 12th. And in that, I look at the impact of being able to offset these losses against your future gains. And it's a significant benefit. So I'd encourage you to check out that video. Now, thank you so much for watching this video. I genuinely hope that it's helped you understand what all these tax changes really mean for someone looking to buy a property. The good news is it's not all bad news. You just need to understand your numbers. So thank you again for watching. Please hit the like if it's been helpful. And remember, it is the little habits and strategies that you put in place today that can literally make $1 million difference to yours and your family's future. Take care, and I look forward to seeing you in the next video.